All right, let's dive right in. In his 2015 letter to shareholders, Warren Buffett didn't just give an update. He basically laid out the entire playbook that built one of the greatest value creation engines in history. We're going to deconstruct that playbook, not just the theory, but the specific, practical frameworks they use.
Okay, just look at that number. That's Berkshire Hathaway's market value gain from 1964 to 2015. It's staggering. But honestly, the number itself isn't the lesson here. The real gold is in the philosophy that powered this result. It's a repeatable framework, and that's what we're here to unpack.
So, that's the big question, right? What is the actual blueprint? We're going to move way past the headlines and get into the weeds on the exact frameworks for valuation, for capital allocation, and for the long-term thinking that really drives the whole machine. Here's how we're going to break it all down. We'll look at 5 core themes that really reveal the Berkshire playbook. We're going to start with valuation, get into their secret weapon, talk strategy, management styles, and then zoom all the way out to the macro view that ties it all together. So let's start at the absolute foundation of Buffett's entire approach, figuring out what a business is truly worth. And spoiler alert, it's almost never the number you see on the accounting statements. First things first, you've got to get this distinction clear in your head. On one side, you have accounting book value. It's a number. It's static, it's based on history, it's defined by GAAP. And then you have the number that actually matters, intrinsic value. This, right here, is the bedrock of all intelligent investing.
And here's Buffett himself telling you why this gap is so important. He explains that as Berkshire moved from just owning stocks to owning entire businesses, a huge gap opened up. Why? It's simple, really. GAAP accounting means the value of their superstar companies is never marked up on the balance sheet. This creates this massive, unrecorded, and ever-growing asset for shareholders.
Now let's talk about the financial engine that has propelled this whole empire for decades. And this isn't just another business line for them, it's a structural advantage that is almost impossible for anyone else to replicate. I'm talking, of course, about their insurance operations. So what is float? Buffett describes it as money that doesn't actually belong to Berkshire, but that they get to hold on to and invest for themselves. Now, for most insurance companies, this is a liability that they actually pay for through underwriting losses. But for Berkshire, it's been the bedrock of their financial strength, and get this, it's often cost them less than nothing. And just look at the sheer scale of this growth. It's mind-boggling. From $39 million to nearly $88 billion. This isn't just a liability they have to manage. You have to see it for what it is. A massive, often cost-free, long-term source of permanent capital that they can then go out and deploy into higher-returning assets.
And this right here is the key insight. Because new business is constantly coming in the door to replace the claims being paid out, the float acts like a permanent revolving fund. Its true economic cost is way, way lower than what the accountants say its liability is. It's just another source of hidden value on their balance sheet.
So, you have this incredible engine generating mountains of capital. How does Berkshire actually put it to work? Well, let's look at their explicit and, surprisingly simple strategy for increasing per-share intrinsic value.
Here it is, the simple, repeatable blueprint Buffett laid out. It's just a masterclass in disciplined capital allocation. You see the priorities. Start by improving what you already own. Then look for smart, smaller, bolt-on deals. All the while, you're being patient, holding on to your firepower for those rare moments when you can repurchase shares on the cheap or make that one truly massive acquisition.
Okay, so capital allocation is one massive piece of the puzzle. But how the businesses themselves are actually run day to day, that's a whole other thing. And here, Buffett draws this really fascinating contrast between Berkshire's own hands-off approach and the one used by their partners at 3G Capital.
Both of these approaches are obsessed with efficiency, but they get there in totally different ways. Berkshire buys businesses that are already efficient and then provides them a permanent home to keep doing what they do best. 3G, on the other hand, they hunt for inefficiency and create massive value by coming in and fixing it. And the interesting thing is, Buffett presents both as totally valid, powerful ways to build long-term value.
And of course, Charlie Munger comes in with a classic Mungerism that just perfectly captures the Berkshire philosophy. They don't buy businesses to fix them. That's not their game. They partner with great managers who are already wired the right way, and then they just get out of their way.
All right, finally, let's zoom all the way out. Let's look at the powerful macro-level belief that underpins basically all of Berkshire's investments here in the U.S. And this isn't some short-term market call. We're talking about a multi-generational thesis.
Buffett uses this incredible example of farming to illustrate America's real secret sauce, just staggering, relentless, long-term productivity gains. Think about it. Innovations allowed a tiny fraction of the workforce, just 2%, to produce way more food, freeing up millions of people to do other things, and raising the standard of living for absolutely everyone.
And this isn't just some quaint story from the history books. It is happening right now, right inside Berkshire's own portfolio. Just look at the BNSF Railroad. Over 2 decades, they moved 71% more freight with only 4% more employees. That, right there, is the engine of prosperity at work in the real economy.
And this just clarifies everything, doesn't it? Buffett's optimism isn't some feel-good patriotism. It's a calculated, long-term investment thesis. It's a bet on the continuation of this incredibly powerful, wealth-creating trend of productivity and innovation.
So the Berkshire playbook is clear, it's consistent, and it's been executed with incredible discipline for over 50 years. The principles themselves are timeless. The real question for us as we look at the market today is which one of these powerful ideas is being overlooked? Which one is the most undervalued right now?